Okay, so today I'll be going over ICT versus TPO. And yeah, let's get started. So I built a little notion here, like Power 3 versus AMT. And I'll be giving this notion out for free too. So today I'll be going over not every single TPO and ICT concept. I'll be going over just the very basics. So if people want to, let's say people want to go into order flow that came from ICT, they can watch this video and they can kind of see what it kind of is in terms of their language, I guess you could say. I'll be going over very simple stuff, like I said. So yeah, don't expect every single nuance to be in the TPO or in ICT that I'm going to talk about in this video. And yeah, let's get very started. So I made this little graph right here, this little table. So we have our similarities between TPO and ICT. So we have similarities, imbalances, rebalancing zones, and directional bias. So these are similarities. Bias I won't be going over today, but there's a bias in maybe AMT and Power 3. That's what I kind of mean by directional bias. Rebalancing zones, I'll be going over that later in this video. And imbalancing, I'll also be going over later in this video. The origin is auction market theory, right? Smart money concept is the ICT, but it can also be Power 3 and directional bias. And also, draws of price on highs and lows can also be a bias too, which I'll be also going over in this video. Focus, price levels, market sentiment, and visualization, market profile, and price action. So those are the differences in these. So I'm going to go over the concept comparison, and later in this video I'll be showing examples of these simple ICT and TPO concepts. Now, like I said, there's a bunch of nuances in both of these respectable languages, I guess you could say. There's a bunch of nuances in both ICT and TPO, like a lot. And if I did go over every single one, this would be a very long video and a bunch of work for me. You know, this week I was just busy with a bunch of shit. But yeah, other than that, yeah, I don't want I'm yapping. Okay, so we got our TPO concept and we have our ICT equivalent, and we have how they correlate together. So we have a POC, point of control, equilibrium, dealing range, and midpoint. So in ICT's videos, usually when there's a big range, ICT does say that, and there's a premium and discount. So let's say we're bullish, and price creates a big move up to form that bullish bias, right? So usually what he would say is that, well, it's going to go back into the 50% of equilibrium or go into discount, and yeah, so you can buy for a better price, which is basically kind of auction market theory. You want to buy for the best price, so it goes into discount, or you want to buy for the best price if you're trying to sell, so you go into premium. It's the same thing. So how they correlate not the power theory. Point of control is the price is where the most time was spent. Yep, in volume. Well, that's the volume profile. That's the VPOC, but yeah. ICT often talks about rebalancing and mean to the mean after liquidity is swept. POC acts as a magnet similar to ICT's concept of reversion to mean after displacement. So exactly how I explained it. And I'll be going over like this too. So just look at this real quick. This is a TPO chart, all right? And this is a bar chart or candlestick chart. So we have our big displacement down, right? So we grab our fib, right? And we try to go to equilibrium, which is right here, right? This is equilibrium. And the crazy thing is that the POCs where the most time was spent right here, the most volume traded right here, and you can see that, well, they kind of match, right? And like they match so much that they're literally almost on the exact same line, which is crazy, right? So the red is the POC and the points 0.5 is the equilibrium. And this is not going to be every single day it's going to do this. This is like a cherry picked example, but it is almost like it. And I'm just trying to teach people that are coming from ICT into order flow, like kind of what they are. Okay, so you can kind of think of a POC being the equilibrium of a low range, you could say. And sometimes there's going to be different profiles. Like, let's say this is like a P profile, so the most volume is going to be spin up here. So if you draw your equilibrium, it's not going to be as the same right here. So it's going to be different. This is just like a cherry picked example, but you can kind of think of it as like that. So next one is poor highs and poor lows and buy side, sell side liquidity. And I'm actually gonna delete this because I changed my mind about that. So poor high, poor low represents incomplete auctions. ICT uses buy and sell side liquidity or a range. Oh yeah. This is kind of, I kind of deleted this, but yeah, I decided not to do this. But daily, weekly highs and lows where price seeks insufficient or liquidity. And yeah, I'm gonna explain this in right here. So we have a poor low right here, which is not that much excess. So excess is like these highs or this low right here, where basically why it goes up like this, why it gives a big tail. And the reason why it gives a big tail is because there's a lot of buying pressure that happened very fast right here. So that's why it happened very fast. So that's why it left a tail right here. And if you kind of see this, there's not a lot of buying pressure. If there was, it would create this. So there's not a lot of buying pressure. So it's kind of an incomplete auction kind of. So it needs to go complete the auction. That's what it did down here. And that's basically what it is. In ICT terms, it goes with sell side, buy side liquidity. Buy side, sell side liquidity. So right here is our poor low, and you can see that it sweeps, right, sell side, and it goes higher. But in reality, it needs to finish the auction, right, because there's not a lot of buying pressure right here, unlike right here, right? So that's what needs to happen in price. And it's not going to happen all the time, but I'm going to explain what it actually is. And there's going to be higher time frame, lower time frame ones. Like you can see that, there's no good examples on this chart, kind of, but yeah, there's going to be higher time frame, lower time frame ones. This is kind of a higher time frame one. So I'm going to explain to you single prints and fair value gaps. Single prints happens when price moves too fast to build value. Like a fair value gap in ICT, avoid that price often returns to fill. So they're pretty much the same thing. Also with fair value gaps, I didn't add a picture in there, but they often are low volume nodes, which technically is a single print. They're low volume nodes, and they 15-minute and above are likely to be low volume nodes. And the reason why CE works is because they actually line up perfectly with a low volume node, which is kind of weird, but it does. And so this is what kind of is right here. So you can see a single print right here. And the reason why they're called single prints is because there are single letters right here. This is an imbalance in price. You can see that there's low volume right here. There's not much volume as right here, let's say. So this is where price comes to fill. And you can see on the ICT terms that almost reaches the CE right here. So yeah, that's what it basically means. That it comes to fill this price. And that's the equivalent of order flow in ICT. So we have our next one, which is price auctions between value and extremes, draw liquidity, displacements, and reversions. Both models see price as constantly rebalancing. TPO focuses more on value and value low, value high for the simplest reversions on TPO. Draw liquidity focuses on where price has prior reactions and can be used as simple reversions. So the reason why I put the value low, value high, even though there's a bunch of ways to see reversions on the TPO, it's just the most simplest way. It's not gonna happen all the time, but sometimes it does, and you can catch an easy trade off of that. But this is probably the simplest way of explaining to maybe a new person that's coming into TPO what value high, value low is, and you can kind of see that they kind of do the same thing. So it's not gonna happen all the time, but just like fair value ups don't happen all the time. Nothing's 100% in trading. So extremes draw liquidity in sweeps. So extremes can also be in the volume profile, but I'm gonna explain this in the value high, value low. So we have our value low right here, right, and we have a previous value high right here, and see that there's a reaction right here. There's a reaction right here. So at its very low, this would be a sell side right here. So you can see that it's the exact same thing right here. So we have our sell side, we have our inefficiency right here on the fair value app. But you can also see that right here we have our value area low, which can be the simplest reversion. So you can see that we have our sweep and then we have our reversion right here. So we have excess and rejection block, or rejection wick. So excess in market profile refers to extreme top or bottom of a profile where the auction ends, or incomplete. Yeah, I forgot to add that. But a sign that market rejected those prices with little to no acceptance. Few TPOs form there, like letters, I mean. It shows up as a single row, letters, at a high or low in a TPO profile. So this can also be rejection wick too. So this is like an example I found. I haven't really found a lot of rejection wicks be respected and current price action. I have found some, but not ones that relate to, that correlate with the excess. So they might be more lower time frame ones, but you can go on lower time frame TPOs, but they might not be as good. They can be good, but in certain ways they can be good as lower time frame TPOs. But I won't be going over that. So you can kind of see that there's an excess right here where price left very swiftly, and you can see as rejection block, we have a rejection block. So you can see that price left very swiftly, hit the CE and rejected again, but it's the same thing as X's. So this can mean, like, all this can, like, if you trade ICT, you can actually see like why price reacts off these phenomenons, I guess you could say. Not phenomenons, but they're by math and by actual volume and by value. It's not phenomenons. In ICT, it's phenomenons because you're not actually knowing why it works. LVN, excess, we have our order block right here in ICT terms. And we have a low volume node, LVN, is just below the TPO area where it moves launch upward or downwards, doesn't matter. Often near the bottom of excess. It's basically just where not a lot of prices traded at. That's why I said like a fair value gap. There's not really a lot of prices traded at, not balance or not consolidation. So this is kind of an order block right here. So you can see this right here. This also goes with value highs, value lows too. Some of them do line up. Like there's an order block right here. This is an order block. So you can see ICT traders are going to say, okay, well, we respected this order block right here, and that's why I went lower. But actually, on the order side perspective, that we actually have a value high right here, gets respected right here. We also have X's right here, gets respected, and we also have low volume right here, also like a little shelf right here, gets respected right there. So you can actually get more accurate. You see that it hit the very top instead of hitting the CE right here. So you can hit the very top right here. So it gets more accurate like that. So this is very simple ICT, very simple TPO concepts, but yeah, this is just the very beginning. So which is better? I personally think TPO is better because it actually has math and meaning behind its concept. Unlike PD arrays, PD arrays still work due to order flow, but TPO, you're seeing the real data and how the market is truly behaving. Most ICT strategies rely on PD arrays and often combine it with tools like standard deviation and SMT, which might actually be due to heavy lifting. PD arrays often represent order flow in a way, but not all of them are reliable or effective. That's why having proper filters like TPO is actually showing market data and value is so important. And in the future, I'll be going over standard deviation and SMT, and why they work. Standard deviation is actually kind of weird on how it's working, but I'll explain it in that video. But yeah, this is what I think. And mind you, I did not use PD arrays or I did not use TPO. But yeah, this is kind of what it is. And it's the most simplest form if you're trying to get into TPO from ICT. So yeah, and this can actually explain why your ICT concepts are working. And this would be in the future. I'll be creating standard deviation, SMT, and yeah, they do the heavy lifting, I think. PD arrays, not all PD arrays work. Not all order flow works, but of course, if you combine confluences, they can work. If you combine risk management, psychology, it can work. So I'm not saying ICT isn't completely wrong. There is reasons why it works, just like I showed you right here. I'm just saying that you need to have a filter to figure out which ones are actually going to work, and maybe your filter is standard deviation SMT, which is good. I like that. So yeah, it's kind of how it works, and this is my TPO versus ICT. It's a very simple video. I'm not going to go over that much stuff because it'll be a lot of things to go over if I created like a lot of nuances, because the TPO has a lot of nuances. And yeah, and also ICT has a bunch of nuances too. So yeah, so this is a very simple video, and yeah, that's basically it. Thank you.